All right. Happy Friday, my friends. Hey, real quick, if you guys wouldn't mind, just give me a little heads up here in the chat. Just make sure you guys can hear me okay. I did this last week too, but I forgot to double check the audio before going live. So I just want to make sure we're all good to go. One thing you might notice, lighting looks pretty good tonight. Lighting looks pretty good. So I'm going to actually, with that, knock on wood, and hopefully it stays that way. But anyway, I think we've fixed the problem. But okay, Phil says, okay, you guys are saying you can hear me. Fantastic. Happy Friday, everyone. Welcome back to another Dividend Happy Hour. I think this is episode 103, which is pretty crazy. And as I'm sure you guys know, these last couple of days, today and yesterday, were just insane. Totally insane for dividend investors. Right now, my portfolio is sitting at an all-time high. We'll take a look at that in just a moment. I'll show you guys where we're sitting. But before we get into that, I want to know a few things from you guys here in the chat. Number one, what did you guys buy this week? What did you add to your portfolios? I want to hear which stocks you picked up. Number two, I want to know what you're sipping on tonight, what you brought to drink to the Dividend Happy Hour. Personally speaking, I'm just finishing up a little. I'm taking a page out of Chris's page book, or out of his playbook, excuse me. Just finishing up a little Ghost energy drink here. I started drinking this maybe an hour and a half ago, and I just have a few sips left. So that's what I'm sipping on here. So let me know what you guys are drinking. Number three, I also want to know, if anything cool happened in your guys' portfolio this week. Maybe you, well, I'm sure some of you guys are seeing all-time highs in your portfolio. I'm sure that's something. I'd also like to know, maybe you've bought your 1,000th share of SCHD or something crazy like that. But any cool milestones that you guys are celebrating as it pertains to your portfolio, share them here in the chat. I want to give some shout outs for that as well. So let me know those few things if you wouldn't mind. I realized, though, one thing we just forgot to do. I don't know how. Guys, we forgot our cheers. So whatever it is you're sipping on tonight, grab it. Here's to the pursuit of that sweet, sweet cash flow. And also here's to you guys. I really appreciate you guys tuning in and spending this next hour with me. It's going to be a fun live stream. As always, I look forward to this one. Look forward to this one all week. So I'm happy to be here with you guys tonight. So cheers. Thanks for tuning in. Sorry, I did that backwards. Let's see. I'm going to scroll up in the chat real quick and just say what's up to everyone here in the building. Looks like we've got 111 people in the stream so far. Nice. We are off to a great start. So all the way at the top here, I see Silarip. I don't know how to pronounce that, but hey, I'm glad to see you here in the chat. Thanks for tuning in. I see JJ, Mr. Smith, Andrew's here, Janice is here, River HB, Investor's Edge, Michael, Alexander, Fildo, Matt's here, DGI Crab, Shamizzle in the Bizzle, Shannon's here as well. We got Striper Kid, Mike, Haas, Caesar's here, Kevin, the backdoor assassin in the building. Tyrone is here as well. Greetings from the 313. There we go. Benny's here. Nort is here. Anson, good to see you. Burn Survivor, what's going on? Happy to have you. We got Yeah Man. We've got Antonio, aka El Dynamico. What's going on, my friend? Let's see. Eli's here. SCHD went off this week. Yeah. I think SCHD is like right there at about $80 per share, right? Unless maybe they officially hit it before the market closed. No, 79.64 according to my spreadsheet, but still pretty solid. Let's see. Blaze is here drinking a hard seltzer. Big day for Blaze on Friday. Opened 4 new positions. Wow. UPS, McDonald's, Nike, and CSX. Nice. Okay. This is cool too. Cam here says first time in the live stream and new to the channel. Well, Cam, first and foremost, welcome aboard. I'm happy to see you here in the Dividend Happy Hour. And real quick, if this is your guys' first time tuning into the live stream, let me know in the chat as well. I'm curious to know how many first timers we have here tonight. And just for all of you guys who are first time Dividend Happy Hour attendees, we do this live stream every Friday night at 5 p.m. Pacific time, 8 p.m. Eastern time. So this is a weekly occurrence here on the channel, and I hope you guys enjoy this one and come back to all the future ones. So, I mean, we're 103 episodes in. It's been a lot of fun. So, yeah, it's always good to see new faces in here. But anyway, I'm 32 years old and recently took the plunge and invested my 20K savings in dividend stocks. Nice. So McDonald's, Johnson & Johnson, SYY, I think is Cisco, AbbVie, Visa, and then looking to add VU or SCHD. I'd say man, first and foremost, great job getting started with investing. And it sounds like you're off to a good start. That's a pretty solid batch of holdings there. As far as VU or SCHD, I personally own both in my Roth IRA. I think they're both really great options that give you exposure to some different things. So with that said, I actually don't think it'd be bad to, if you're looking to add one or the other, I actually don't think it'd be bad to add both of them, do like a 50-50 split between the two. So that's always an option. But anyway, let's keep going here. Bear fans here. Alexander bought 20 shares of Alibaba this week. Looks like a big week for Bear fan. Rolled over my 401k to an IRA. Picked up 184 shares of SCHD. Nice. 35 shares of QQQM and 13 shares of VU. Wow. That is a great week of buying. Nice. Let's see. Mike picked up some Coca-Cola in Main Street. Kitchen Prep ASMR. Picked up some Bristol Myers Squibb. There you go. Yeah. Nort here has an all-time high. There you go. I see some of you guys out there sipping coffee. Nice. Very nice. Striper Kid, some decent buying here. Starbucks, Kenview, and Coney. I can't say I'm a big fan of it, but man, I hope it works out for you. That's one of the Yield Max funds. I think the Coinbase Yield Max fund. We don't have to get into Yield Max. Don't do it. Don't do it, Ryan. Keep going. Just don't do it. Michael picked up some Visa and AVUV ETF. Okay. Drinking Bush. Okay, nice. This is a cool milestone. River HB hit the 400K milestone in the portfolio this last week. That's awesome. Unreal. $400,000. Good job. Tyrone also with a really cool milestone. Sipping some tequila, which I love. I love my tequila. Hit over 15K in the portfolio. That's awesome. JJ also with another milestone. 80K in the portfolio for the first time. Nice. Very, very nice. Let's see. As far as some other buys, I see a lot of McDonald's. Here in the chat. Benny, Alexander, and Phil all picked up McDonald's. Those three comments were all in a row. Everyone picked up some McDonald's. I see some Starbucks. A lot of Starbucks. What else? There we go. Antonia picked up some Vici properties. Nice. And got a nice $94 dividend payment from Altria Group. Very cool. Yeah, I had when was it? It was Monday or Tuesday. I think it was the 7th or the 8th. No, the 10th. So would have been Wednesday, a couple days ago. Right? That was when Altria paid. So couple really nice payments that day. One from Altria for $55. KRC, I think, was almost $42. So overall, really solid day of dividends. This month is going to be great. Really great day of dividends. And then, just last week, we had SCHD and VU paying. So July is a hot month for dividends. It's just a hot month in general. So here in Vegas, guys, I think we had record temperatures this week. From my understanding, I think I don't remember the highest it got up to. Maybe it was like 118 or something like that. So it's been pretty toasty. Let's see what else we got here. Pretty nice week of buying for Chris here. VU, SCHD, Nvidia, Google, Microsoft, Realty Income, Visa, and sold UPS. Okay, we were kind of talking about that on Instagram. And I think UPS was maybe one of your smaller positions, right? And that's kind of why you sold it. Oh, Tito's and Gatorade. That's classic. That used to be like me and my roommates. That was like our go-to drink. We used to get the blue Gatorade and mix it with Tito's. And that was like I said, that was just the go-to. Not bad. Not bad at all. Let's see. What's up, Journeyman? I see you there. What's going on? Jorge's tuning in at work. What's up, Jorge? We got Christian, Fatima, Frank R. First time catching the live. Well, welcome, Frank. I hope you enjoy the stream. So once again, we're going to run it for about an hour. It's usually about how long we do it. Yeah, always enjoy these weekly streams. And I should say, guys, I don't really need, well, I guess so. I'll mention it next week too. But so next week, we're going to have our normal stream, but the week after that, which would be 26th, I believe. I don't think we're going to end up streaming on the 26th, just a heads up. Me and my wife are going to be going on our honeymoon next week to Mexico, or not next week. A week from Sunday, we're going to be going. So I just don't know if a live stream will be in the cards the week that we go. Just a heads up there. I'll bring it back up again next week. But let's see. Wow, Matt had some really nice purchases. Sipping on a Miller, picked up more. Basically, I think invested $1,000 into Pepsi, SCHG, UNH, EPD, Realty Income, and Visa. So yeah, a lot of different stocks there. What else? What other ones did I miss? I see some more Starbucks. Andrew picked up some Starbucks. Nice. Jim, some really nice purchases here. 10 shares of J&J. Great time to buy J&J. 20 shares of Verizon. 20 shares of EPD. Very nice. And EPD just announced a slight little dividend raise. And Mondelez, 5 shares. Nice. There we go. Excuse me. And Sandwich here, first time watching the live as well. 3 a.m. over there. It's 3 a.m. I must be lonely. And I say, baby. Who is it, guys? I can't help but be scared of it all sometimes. Who is it? Elijah, how often did he do the live streams? Every single week, my friend, every Friday night. Yeah, a lot of first timers. Investor's Edge first time, Fatima first time, Anson first time, Ahovi first time. There we go. That's cool. Alexander's first time. Wow. Sudhendu Agarwal first time. Nice. I hope I pronounced your name right. Cool. Elijah's first time as well. Nice. There we go. There we go. Dan the man's in the building. What's up, man? Good to see you. Hope you had a good week. There you go. This is cool. Ahovi, I'm 18 years old and I'm almost at the 10,000, almost have $10,000 invested. I've been investing mostly in individual stocks, but some SDHG as well. Should I be chasing dividends or more growth stocks? It's a question as old as time. And there are a lot of people out there who think you should just go for more growth-oriented investments. And I would agree with that, but I think that, you can have your cake and eat it too. Like if I was you, I would go the dividend growth route. And I think that's over a long period of time, that's going to give you the best of both worlds. And the reason being, you'll get both growth and dividends and increasing dividends. I should say that's the best of both worlds. And the reason being, because for a company to be able to grow their dividends, they have to continue to grow their earnings and grow their free cash flow over the years. And if a company's doing that, the dividend payments per share should continue to go up over time. In theory, that should be how it works. So you'll benefit on the dividend side of things from that, even if you're, buying into a company like, let's just jump over to Seeking Alpha, and this is where some people kind of get turned off by dividend growth stocks. So let's look at, I guess Visa is a pretty good example. You're 18 years old. You've got plenty of time. So like Visa, for example, right now it's got a 0.79% yield. Not great, right? Like that's not something to write home about, but the 5-year growth rate is fantastic, about 16%. So with that, let's see if it'll show us a yield on cost here. So with Visa, if you go back in time, like let's say you went back to 2014 and you were able to buy, a share of Visa or whatever, the shares that you bought then would be, your yield on cost with those would now be almost 4%. So as time goes on, your yield on cost will increase, meaning the cash flow return on the initial shares that you purchased will continue to go up over time because of that dividend growth, because Visa is able to raise their dividend payments at such a high rate over an extended period of time. And if that were to continue, then your yield on cost will just continue to go up. And that's fine for someone like yourself who has plenty of time to let this type of situation play out. So there's not much of a rush to rush into higher yielding stocks, in my opinion. So that's part A of all this. Part B is if a company, actually, let me rephrase that. Part B to this is typically over an extended period of time, as they say that earnings growth is what drives share price growth. Meaning, if a company is growing its earnings per share, if it's growing its profits, then over a long period of time, you should see the share price go up over time as a result of that. And on the inverse of that, if a company is decreasing their profits, if they're decreasing their earnings over time, then we might see the share price go down. And there's plenty of examples that you can refer to see that in action. Like Visa's a good example. I mean, Visa, in my opinion, is like the gold standard of stock. So just looking at the share price performance over these last 10 years, it's obviously done really well. It's up 380%. So you would have benefited from some really nice share price appreciation from buying the stock over the years. Now, if we look at the financials for Visa, we can see that the trend is pretty similar to what happened with the share price. The sales have gone up, the gross profits have gone up, the operating income has gone up. The net income, which is basically the earnings, not on a per share basis, but the absolute earnings, have gone up over time. And so if you see a chart like this, it would be surprising to not see share price growth come along with that over the years. And these are, in general, these are the type of companies, if you're going to be buying individual companies, these are the type of companies you want to invest in, the ones that are able to continue to grow their sales and grow their earnings. Over the years. This is, like I said, this is like the gold standard. This is exactly what you want to see. And if we look at the free cash flow as well, it's going to be a very similar trend. Visa is just so good. So anyway, as far as individual stocks go, I wouldn't worry about chasing dividends or more growth. I would concern yourself with finding companies whose financials look somewhat similar to that, who are growing their sales and growing their earnings, and are also companies that you understand. You understand how they make money, and you understand how they operate, and you understand the pros and cons that come along with investing in those types of companies. I think you should concern yourself more so with that. And if you want to make dividends a requisite for the company that you invest in, meaning, the company has to pay some dividends, it has to have some sort of dividend policy in place, then that's your personal preference. But even within dividend paying stocks, you can find ones that will give you some really good share price appreciation over the years. So they might not have the highest yields. And I shouldn't say just share price appreciation. I should say total returns, which is share price appreciation plus dividend income. So there's plenty of great dividend paying stocks that will give you the best of both worlds and can help you generate solid total returns. So, hopefully all of that made sense. That's a pretty tough question to answer. It really is. Okay, let's keep going though. Let's see, Pedro, do you think about PSEC ETFs? So I think what Pedro is really asking is, what do I think about PSEC? And PSEC is Prospect Capital. I don't remember exactly what PSEC does. Maybe they're a mortgage REIT. No, they're an asset management company. Okay, a business development company. So I'm not particularly the biggest fan of PSEC. It's fine. I used to kind of throw it into the yield trap category. And let's just take a look at the dividend history in a moment. But we can see that it's got a really high yield, which I would imagine is why you're asking about it, and maybe why it's on your radar is because it has such a high 13% yield. But looking at the dividend history, it's not the best. I mean, in their defense, it's been steady since 2018. So for the last 6 years, they haven't decreased their dividend. But prior to that, they've had a pretty, there's been a few times where they've reduced the dividend. So in the last 10 years, the dividend's basically been cut in half. So I don't think that's great. This is not as bad as other companies like, for example, ORC, Orchid Island Capital. If you come across a stock like this that has a dividend history chart like this, just pretend it doesn't even exist, because it's not worth it. And a lot of investors would go for something like this because they see a 16.8% yield, but this is not what you want to buy. So I think when it comes to the high yielding stocks, you definitely want to look at the dividend history and see, really any stock in general, but dividend cuts are certainly more prevalent with higher yielding stocks. So you want to definitely do your due diligence on the dividend payment history. And if you see something like this or something even remotely close to this, I wouldn't entertain it. So that's just me personally, though. So anyway, let's keep going. Really good questions tonight, guys. Really good questions. Kellen here with a good question. So, hey Ryan, I'm wondering if you'd consider doing some home buying content, saving, how you're thinking about down payment and interest rates, balancing saving and investing, etc. Might be newsletter material. Yeah, I kind of touch on that a little bit from time to time. Like in the newsletter that went out yesterday, I did talk a little bit about budgeting actually in like the Q&A section of the newsletter. So definitely check that out. It's on the website. It's like the most recent newsletter article on the website. But yeah, I'd be open to talking about some of that stuff. I mean, if there's any specific questions, I'm happy to answer them. If you have any specific questions in any of those categories, I'm happy to answer them for sure. So let's see. Okay, Emmett wants to know opinion of Thepi. I keep hearing about Thepi. I keep seeing it in the chats and the comments, and I don't think I've looked it up, but maybe I have once. I don't remember. So let's check it out. So this is going to be a covered call ETF. One of the first things I noticed, 0.65% expense ratio. I think that's about in line with what we might find with like the YLDs, right? I think theirs is about the same. Yeah, so 0.6. So Thepi's is just a tad higher. So higher than JEPI's, because I think JEPI and JEPQ are in like the 0.3% range, 0.35. So yeah, JEPI and JEPQ, you're getting a lower expense ratio. Yeah, uses options, some of these holdings. So I'm guessing it trades options on these bad boys right here. Well, actually, let me look. Let me actually look at this. Okay. I should probably just read it. Okay. Capital appreciation and current income. So does it say what it does? Invest in growth and value stocks. So invested them and then it uses options. So it probably just writes covered calls. It owns these stocks. I'm guessing it owns these stocks and then it just writes covered calls on them. And okay, that's that. I think that seems pretty straightforward. High yield, 16.7% in the trailing 12 months. And the dividend payments, I mean, it's only been around for half a year, maybe 7 months now, 8 months now, excuse me. So, and the dividend payments have been pretty steady, but so I think that seems fine, but here's the thing. It just really hasn't been around for long. So I guess like my opinion on it seems fine so far, but who's to say what this fund is going to look like a year from now, 2 years from now, 3 years from now, 5 years from now, 10 years from now? I don't know. It's kind of a gamble. So I don't really know what to make of it. And this is one of the reasons that I've really just kind of stopped paying attention to a lot of the covered call ETFs. First and foremost, like all of them, I think the ones that's been around the longest is JEPI since 2020. So that's at least got a couple years now or a few years under its belt. But even the same thing with that, it's just too soon to tell. It's just too soon to gauge like the long-term viability of these covered call funds or these income funds. That's number one. Number two is like at this point, I just feel like they're a dime a dozen. There's too many of these to keep up with. It's like a new fund is coming out every single day. There's more investment products like this than you can count. And I just don't, I'm kind of at a point where I don't really know how to differentiate between them because they all just seem way too similar to me, and everyone's coming out with their own version of the same thing, it seems like, to me. So I tend to just stay away from these just because, like I said, it's just so, there's just so many of them. It's just become such a watered down thing. And I don't know. Just don't know how long a lot of these funds are going to last. I don't know. Like, I'm not saying they're going to go out of business tomorrow or they're going to shut down tomorrow or next week or next year, because I don't know. But that's why I'd rather not invest in them. So hopefully that makes sense. I know that's kind of a tangent on these, but it's just not my personal cup of tea. I'd rather go with individual companies, these ones that are more tried and true. I personally just feel better about that. So, let's see. Let's keep going. Yeah, Matchbox 20. There you go. 3 a.m. I must be lonely. Now I'm getting into Creed. Lonely when dreaming, got a tour around the world. Don't even get me started on Creed. I can hear it in my head now. It's like, now I just want to, can you take me higher? I don't know why you guys watch me. This is ridiculous. There we go. Yeah, El Dynamico. That's funny. Ooh, this is a good question. Well, before I get to this, I want to give a shout out to Mike here. That's great. That's a really cool milestone. 50K in the portfolio. So, I got to shout that out. Good job, Mike. That's great, man. Keep it up. Alexander says, what watch do you got on? So this is I haven't worn this one in a while, and I just wanted to bust it out today because it's been too long. So this was one of my uncle's watches. He passed away. But this is a Bucherer. You can see it's got the skeleton dial there, the skeleton face there. You can see all the gears and stuff under the dial. You can see all the gears turn in, and you turn around. Got that as well. But the watch brand is Bucherer. And Bucherer, I don't know which one they were first, but they were a watch manufacturer and are a watch retailer. I'm not sure which one came first. I don't know if they made watches first or if they did retailing first, but it's like probably the biggest watch retailer out there. And now, actually, just in the last, I think sometime in the last year, Rolex actually bought all of the Bucherer stores. There's one of them here in the Forum Shops at Caesar's Palace in Vegas that I like to go to. But yeah, it's the same brand that has the stores that made this watch. And my guess is that this watch, just based on the font, it looks like it's maybe from like the 80s or 90s. I think it's really cool. I think it's got a really unique dial. And it's unlike any other watch I have. Plus, it was my uncle's, so it's kind of cool to wear it. And the other gold watch I have, the Bulova, that you guys see me wear a lot of the time, that was his as well. The Chevron watch, if you guys remember me talking about that. Okay, let's keep going. Uh-oh, I see my mother-in-law in here. Say hi to Lori, everyone. Hey, Lori. Thanks for tuning in. Okay, let's keep going. Let's see. Kevin, do you think it's a good time to buy Visa right now? Too high? Will it go down? So I don't really know. I don't know what the share price is going to do, but it has come down a little bit these last couple of weeks. Not too much. It's now in the mid 60s, so that's at least good. Still up almost 10% for the year, but down about 3.5% in the last month. And my personal position is in the red. I think my average cost is like right at 270. So it's getting toasty in here, guys. So I personally think it's not too bad of a time to buy. It's probably about fair value for Visa right now. It'll be interesting to see what the share price does from here. I mean, what will happen is anybody's guess. It's like your guess is as good as mine. So anyway. Eric, thoughts on American Express? I think American Express is a really solid company. In my own portfolio, I opted for Visa, and obviously, and one of the main differences between these two, so Visa is just a payment network, meaning they don't issue cards. They're not responsible for issuing debt for those credit cards. So Visa is basically not on the hook for, consumer line of credits. They just facilitate the transactions. They just are kind of the toll booth and kind of the gateway between the buyer and the seller of whatever the transaction is. Now, American Express does that too. They have their payment network, but American Express is also an issuer of cards, which makes them or puts them on the hook for the debt. But still, like, this is obviously a powerhouse company, and their financials also look pretty solid. So we can see, very consistent revenue growth, pretty consistent net income growth as well. Earnings per share has been really nice. Oop, I don't know what happened there. Whoops, we've hit a bottom. Huh. I have never seen that before. Huh. Interesting. But yeah, I think American Express is fine. I think when it comes to Visa and MasterCard and American Express, yeah, I think they're all great. MasterCard and Visa are, like, the model is pretty identical, so I don't think you can go wrong with those. One thing I would like to look at, though, let's do a little comparison just for fun between comparisons between. We'll just look at Visa, we'll look at MasterCard, and we'll look at American Express. So we'll look at a few different things. We'll compare the margins, the dividend stats, and let's take a look at the total return while we're here as well. So interestingly, over the last 5 years, American Express has outperformed the other two. Over the last 10 years, not necessarily the case, but in more recent times, American Express has done pretty well. Looking at the dividends, American Express also has the highest yield. Excuse me. It's the only one that's over 1%. Looks like payout ratios are all pretty similar. 5-year dividend growth rate, it does have the lowest growth rate and also the lowest dividend growth history. So there's that bit of a trade-off, the higher yield, but you're getting the lower dividend growth rate. Personally speaking, especially considering there's not a huge difference between these two yields, or really even between MasterCard and American Express, I personally would prefer to have the higher dividend growth rate. If I'm planning on owning this for 10, 15, 20 years, then over time with the higher growth rate, the yield on cost will outpace that of the company that's growing their dividend at a slower rate, especially when these yields are relatively close-ish. Continuing on, though, looking at the growth. So revenue growth between all of them. Let's actually look at the CAGRs. It's all pretty similar. MasterCard's growing their sales at a faster rate than both Visa and American Express, but they're all they're all not too far off from each other. Net income over the last 3 years, pretty similar, right? So that's good to see. Free cash flow growth, it's not really giving us anything for American Express. So not too sure what to make of that. So we can just leave it at the net income here. So, but it's all pretty similar. As far as margins go, Visa and MasterCard definitely take the cake. Net income margin, same thing. American Express is a much less profitable than Visa and MasterCard. And it doesn't show any returns on capital either. So MasterCard's is really nice, though. And I think this is just in the trailing 12 months, return on total capital, 42.5%, pretty dang good. So yeah. And I think, from my understanding, the trade-off between Visa and MasterCard, Visa is the larger payment network, so they facilitate more transactions. But as we saw, MasterCard is growing at a faster rate. So there's that. But anyway, hopefully that helped. Hopefully that helped. Let's see. Shout out to my neighbor in Vegas here, David, sucking down some cold ice water, trying to beat the heat. I know. So my AC's on to 76, I think. That's usually the lowest we'll put it at, and it's like that's usually fine. But sitting right here in front of the window with all these lights on and stuff, and there's not the best like ventilation in the room, so it's starting to get a little toasty. It's okay though. Oh, good question. So what's going on with ABR and the FBI? I read a little snippet about that this morning, but let's take a look and dive a bit deeper into what's going on with ABR. So this is Arbor Realty Trust. They had a crazy drop today. They were down 17%. It drops after reports of a federal probe short seller attacks. So, okay, after a media report said federal prosecutors and the FBI are looking into the REIT following short seller attacks against the company. Okay, so the authorities are investigating lending practices and its claims about the performance of its loan book. Bloomberg reported. Maybe we can get a little more insight there. We routinely cooperate with regulatory inquiries and are very confident that we conduct ourselves properly. So everything's copacetic according to ABR. Smells a bit like MPW. Okay, so there's a little more insight here. If the undisclosed related party transactions are true, and everything seems like they are, they have committed a fraud by intentionally hiding bad loans off the books from investors. Kaufman, who's probably the CEO, I don't really know, obviously lied about it at the 2023 conference call when he said the company's willing to take the foreclosed properties off their hands are lining up for them. At the Q1 call, we discovered the claims about foreclosures were lies because they decided to restructure the loans by lowering the payments below their cost of capital with the hopes of kicking the can and recovering when the property prices pop. Okay. The result of the investigation might mean that they will be kicked out of the agency business and their bridge loans mature soon and they will have to continue refinancing and restructuring them to appear like nothing's happening. The investigation will bring about higher weighted average cost of capital, both on the equity and debt side, meaning they won't be able to grow. Okay, so what is okay? Bloomberg won't let me read it. Okay, so maybe some potentially fraudulent activity for ABR. Maybe, I don't know. Okay, undisclosed related party transaction to hide loan loss is certainly fraud. Okay. And this is another kind of opposite opinion, it seems like. So Ivan owns 10 million shares. I don't know who Ivan is, but personally, he probably cares about his company and what they do and his reputation and personal integrity more than he cares about money. After all, there is only so much stuff one can buy. This guy seems pretty bullish on this Ivan guy. Thinks he's a high class, high character individual. However, the shorts on ABR only care about money. In my view, the shorts somehow manipulated the DOJ to open a probe on the company and advertise the fact and leaked it to Bloomberg just to drive the price down to make money. So, okay. I mean, the incentives for the short sellers obviously are, well, the incentives for the short sellers are obvious. But I don't know. We'll have to see how this plays out. It seems like they're saying that maybe there was some fraud, but the share price going down as a result of this obviously benefits the short sellers. So they have a bias here for sure. Who was the short sellers? That, according to this, it was Viceroy, maybe? I Okay. After reading the Reuters story, I'm now convinced that the Bloomberg offers were paid off and that any investigation was set in motion by short sellers. Okay. On the day that is exactly 2 weeks before their earnings release, meaning that ABR is in their quiet period and can't comment before earnings. How convenient for the shorts. This is a complete hatchet job. Interesting. Okay. Well, I don't know. Let's see what happens. Let's see what happens. Not paid off. As an ex-reporter, I can tell you that many in the newsroom are lazy or underpaid or overworked or brain dead or all of the above. They probably were contacted by some associate of these clownish researchers and were fooled by rumor. Unaccredited sources are not sources, period. So I don't know. We'll see what happens with ABR. Yeah, interesting though. Interesting stuff. This is a good question too from Antonio. So as a dividend investor, is it wise to sometimes jump in and out of some positions just to get some quick cash? For example, jumping in and out of a GNC. GNC. Oh, a GNC. No. I don't. I'm personally not a fan of that approach. I don't like AGNC. That is definitely a yield trap. So I just don't see the. I think maybe what you're describing, Antonio, I could be wrong, but it sounds like what you're describing is something called the dividend capture strategy, which essentially is where you buy a stock right before the ex-dividend date. Typically, it's some high-yielding stock like AGNC. You buy the stock right before the ex-dividend date to collect that dividend. And then as soon as you can after the ex-dividend date, you dump your shares. So you still collect the dividend, but in theory, you don't have, so the strategy supposedly is that you dump the shares right after the ex-dividend date. So you don't suffer from the like share price losses that occur from adjusting for the dividend payment, if that makes sense. It's not really like from my understanding, it's not really a viable strategy. I wouldn't do that. I think you'd be spinning your wheels trying to mess with that type of strategy. I don't even know if you can call it a strategy because I'm not sure what the benefit is to it. I think you're just better off finding good companies and holding on to them. Don't try and get cute with it. Don't try to overcomplicate it. So that's my take though. But with that said, I will add to this. It can make sense, I think, if you find a stock or a company that's just like way too discounted, like undeservingly discounted, undeservingly cheap. And it seems like it's a no-brainer that it's going to go back up and there's like value that you can extract from it. I think it could make sense to possibly swing trade some of that stuff. It becomes more of a gamble because it is, you're dealing with you're relying rather on short-term share price movements, which are certainly not like guaranteed to work out your way, but there could be some merit to that, to swing trading. And I know there's a lot of people here in the community, in the Discord group, who do some swing trading in their portfolio. Once again, for me personally speaking, that's not something I've really entertained. But I do think that if you're looking for quick cash, that something like that makes more sense than the dividend capture strategy. I don't even know why that's a thing, to be honest with you. Okay, Skippy says, this is a good question. So when a company does a stock split, does each new share get the full dividend, or does it vary case by case? This is a good question. So I'll actually give you a real life example here. So if we go over to here, we're going to look at Williams-Sonoma. So actually earlier this week, Williams-Sonoma did a stock split. On the 8th, the stock split 2-for-1. Okay. And let's see if there's any more info here. No, nothing. No, stock dividend, nothing really about the dividend. But essentially with this 2-for-1 stock split, the number of shares were doubled. The share price was cut in half to account for the doubling of the shares. So in my personal portfolio, my average cost prior to the split was about $133, right? And I had 18 shares. So now, and by the way, if you want to grab this spreadsheet, there's a link to it in the description of the video. It's free to download. But now after the split, I have 36 shares and my average cost per share has been adjusted down by half. So now my average cost is 66.54. And similarly, the dividend payment per share has done the same. So it went from 434 or 440, whatever it was, to now being, according to this, $2.17 per share. But it's all the same. It all evens out. The only difference is that you have twice as many shares, and each one of those shares is half the price, as well as the dividend payment per share is also half of what it was before. That's really the only difference with the stock splits. Oops. Here we go. Eric, did you see me? You see me talk about? I don't remember how long ago in the stream it was, but man, I spent a few minutes on American Express. I see you keep commenting about my thoughts on it, but we spent a good few minutes on it. Hope you saw that. If not, just rewind a little bit. We actually compared American Express to Visa and MasterCard, so we talked about it for a good few minutes. Let's see. Man, this is a good question from ex-Dividend Dad. Everyone says I want a dividend growth stock. Look at Microsoft, great dividend growth stock. I would argue this is too late. How do you identify dividend growth stocks with new potential companies? That is a good question. So I think the first answer that comes to mind is to maybe look at companies that have like just recently started paying a dividend. And we have some really, really good examples of those companies lately. Meta's one of them. Salesforce is another one. Google's another one, right? And I think you can look at those companies, even though they've been around for a while, and the valuation on them might not be correct. So in all of this, just valuation aside, but as newer dividend payers, as new dividend payers, I should say, those three companies I just mentioned, at least from what I can see, seem to have a lot of the makings to be really great dividend growth stocks. So with Google, the yield, so they've only had one dividend payment and their yield is 0.11%. So not great. But everything else about this company looks really, really solid. I mean, just look at these charts and everything. And I don't think Google even has any debt. I think they're negative debt on the balance sheet from what I remember. Yeah, by a long shot. So on a net basis, debt minus $80 billion. They're just a money printing machine, as you can see, looking at the free cash flow. So like I said, this has the makings to be a really great dividend growth stock. And if you bought it now and just held on to it, chances are your yield on cost, and I don't know, there's no guarantees, obviously. I don't know how aggressively Google's going to grow their dividend. But they have the financial setup to increase their dividend at a pretty aggressive rate if they wanted to. So I think that'd be a good place to look, is companies that, if you're looking for new potential companies, look at the ones that just recently started paying their dividends. So, or even just look at companies that are maybe they're not new dividend payers, but they're still growing their financials pretty aggressively. They're still like, really solid. There's really solid growth in those companies, because that's what will spur that aggressive dividend growth, right? So you can look at that as well. Hopefully that makes sense. Let's see. Let's see here. Keep going. We got about 10 minutes left in the stream too, guys. Just heads up. David says, Ryan, are you melting in Vegas? It's hot. It's definitely hot. But it's bearable. It's not too bad. Let's see. This is interesting. Dominique bought ABR after the first short report, and sold it 30% gain. Never got back in. Where there's smoke, there's fire. Well, that's cool. Nice return there. Let's see. Let's keep going here. Ryan, here's one. How does CSWC look to you? What is this? CSWC. Capital Southwest. Let's take a look. I've never heard of this company, first and foremost. So let's see. Looks like they've had a really good year. They're up 33%. And they are a BDC. Okay. Looks like maybe credit and private equity, maybe more on the debt side than the equity side, perhaps. Maybe not. I don't know. Seeks to invest in energy services. So, okay, both debt and equity. Okay, cool. So, just at a glance, the financials looked like it was growing pretty well, right? So that's pretty nice. Net income, it's okay. Revenue per share, shares outstanding going up shares outstanding going up quite a bit. That's not all too surprising. Really good dividend growth over the last decade. This looks a little bit concerning, though. The payout ratios, and it's normal to see higher payout ratios with business development companies. But this is pretty high for these last couple of years. So this is something just at a glance, this is something I would keep an eye on right here. 8.4% yield, crazy 5-year growth rate. I'd be surprised if, well, I think that's probably why the growth. Well, no, it's a special dividend. So yeah, it looks like they pay special dividends every quarter, similar to Blue Owl and Main Street. So that's cool. And they've done so for a couple of years. So I think it seems okay. I'd still be more partial to something like Main Street, though, I would say. So like, I think this looks better if we look at the net income. I think this looks, the bottom line growth for Main Street is a lot better than what we saw with CSWC, but I don't think CSWC looked terrible. And we can see that the payout ratio here is a bit more tolerable, especially these last few years. I mean, there were a couple spotty years, 2019, 2020, according to this, but otherwise it's been pretty tame. So that's my take, though. But yeah, CWSC doesn't look too bad. Another one that's really, I mean, Blue Owl is pretty solid. Another one that people keep telling me about is Hercules, HTGC. And this one looks pretty cool too. I mean, net income has overall been trending up, but we'll see what happens. We'll see what happens this year. But yeah, I think this one looks like it has some potential as well. So yeah, anyway. Creed. There we go. right. Ooh, interesting. Nike versus Skechers. What's Skechers looking like? Skechers, SKX. Are they even no, not a dividend payer, but let's see what's going on with Skechers still. Interesting. You wouldn't you wouldn't expect to see something like this from Skechers, but this is impressive. Really nice gross profit margins. Really nice. It looks like the margins are expanding as well. So I think these financials look actually really good. Yeah, like I said, I was not expecting to see this from Skechers. Not bad debt either, right? I mean, we'll see what the free cash flow looks like, but 637 million net as of their last report. Yeah, so in the trailing 12 months, 503 million of free cash flow. So yeah, Skechers is looking solid. Let's see. Ooh, I don't know about this one. Another wonderful buy at the moment is Walgreens Boots Alliance. I can't say that I personally agree with that one. I think I can't get behind Walgreens. I was in Walgreens the other day, but I'm not a big fan of Walgreens. And we'll just take a quick browse through. I mean, we can see, I mean, their sales have doubled over the last decade, which is good. Margins have continuously gone down though, and the operating income straight down. So, and you can see that the margins are getting weaker and weaker over time. And looking at the net income margin, it's to a point where it's negative. So, and it was only for last year in the trailing 12 months. So we'll see if this is an anomaly or if they do the same thing again when they report their 2024 numbers. Looks like next month or sometime in the next couple months. But yeah, I think there's a lot better companies out there than Walgreens. I personally don't see the appeal. It's certainly cheap, right? Like it's down 62% in the last year, but I don't think that means it's a good buy. Personally speaking, that's a dip that I would not choose to partake in. Let's see. Yeah, my man JP, guys, check out his channel. JP's got a really good channel. I've really been enjoying your videos lately, man. You've been doing a great job. So definitely check out his channel, guys. But JP says, do you think the REITs will have a big jump if rates get cut later this year or early next year? Yeah, I definitely do. I mean, if we just look at like today and yesterday, where there was even a hint that could be a possibility. I mean, we saw the way the share price moved just from the hint of that even happening. So yeah, I think if rates get cut, we'll see a lot of REITs pop in share price. So this is a good point from Investors Edge. BDCs are too expensive at the moment. REITs are way cheaper. Absolutely. If you look at the ones like Main Street or Blue Owl, I haven't looked at Ares Capital, see what they've done. But a lot of the BDCs have done really well. ARCC's up 10% in the last year. They've really climbed in share price in the last year. So yeah, they're definitely on the pricier side for sure. Okay, let's scroll all the way down here because it's about time to wrap it up. So we'll see if there's any last comments here. Doesn't look like it. At least watch conglomerates, huh? let's see. So Korean Cardboard, this is kind of an interesting question. We'll make this, we'll make this the last one of the night. Thoughts on using REITs, BDCs, asset management companies solely for income? As long as they don't lose much in share price, more than yearly dividends, I'm content on holding them for income. I would say that most people buy all of those because they are trying to, I think they're buying them more for the income than for the share price appreciation, let me say. So, but with that said, I don't know that I'd want to see the erosion of the share price. I don't know that I'd want the income at the expense of the share price going down, if that makes sense. So if I'm buying a company that is yielding 8%, but then it goes down, 8% per year, but then it goes down 7% per year in share price, that's only like a 1% total return. So that's not really like a good investment in my mind. And I personally wouldn't want to invest in something where that was the case. So, and that was probably an extreme example, but anyway, yeah, I would just shoot for, how do I say this? I think I'll just leave it at that. Does that kind of make sense? I was trying to think of what else I could add to that, but that's pretty much it. I wouldn't want to invest in something that was yielding a lot just to have the share price go down. So, oof. Okay, this will be the last question. Fast Eddie, do you ever think about doing a 2-hour show? For the 100th episode of the Dividend Happy Hour, I went for 2 hours. And it was fun, but it was tough. By the end of it, like I was definitely losing my voice. So I don't see myself making that a regular thing by any means. Maybe every once in a while, like on a special occasion. But yeah, I couldn't do 2 hours every week. That's kind of a lot. So, but anyway, guys, I think this is a good place. I think it's a good place to wrap it up. So 6:03. 3 minutes past the hour. But anyway, with that, thank you guys so much for hanging out with me this last hour. I hope you guys enjoyed the Dividend Happy Hour. This was another good one. They're always good, but this was a fun one tonight. So I appreciate you guys hanging out with me and spending this time. And I hope you all have a fantastic weekend and keep up the great work, everyone. I will see you in the next one. You guys take care.